Welcome back to The Critique. We're looking at a market analysis that explores the tension between Fed rate cut hopes and, on the other hand, fears of a tech and AI valuation bubble.
Let's jump right in.
Okay, so a key theme that really jumps out is this clear identification of two really powerful conflicting forces.
Right.
You've got the boost to U.S. indices, say the S&P 500, from a potential December rate cut. But at the very same time, you see this global pressure. I think the piece mentioned the Nikkei shedding, about 2.4%? And that's all driven by these fears over tech and AI valuations.
It is. The two drivers are laid out very clearly, but the analysis would be so much stronger if it synthesized this tension into a single, cohesive thematic thesis.
Okay, so you're saying instead of two separate things happening at once.
Exactly. Right now, it treats rate hopes and tech bubble fears as two separate buckets of news. And the weakness there is that it dilutes the narrative power that comes from them fighting each other in real time.
I see.
The market story you found isn't just two concurrent facts. It's a conflict. And that conflict should be the engine of the entire piece.
That makes sense. It's a paradox, right? Where good news for one part of the market actually creates pressure on another. But if we frame the whole thing around this conflict, this tension, do we risk making it sound, too bearish? Too volatile?
That's a great point, and it really comes down to focus. The suggestion isn't to just be bearish. It's to use the conflict as the frame for everything.
The lens.
The lens, exactly. You reframe the entire piece around this central paradox, how the market is simultaneously looking for a rescue, the rate cuts meant to soothe things,
Right, to provide liquidity.
while also facing a reckoning from these speculative valuations that suggest a correction is, maybe overdue. That creates an inherent drama that keeps the reader hooked, no matter what the final directional call is.
That synthesis would definitely make the piece feel more original. It becomes a story about a high-stakes tug-of-war. So how do we actually do that? How do we shift the structure right from the beginning?
You have to hit them with it immediately. Craft an opening hook that frames the conflict from the very first sentence.
Like a title, even?
Yeah, maybe a title like The Market's Contradictory Pulse. Why Fed Hopes Are Fueling and Fighting Bubble Fear. Something that grabs you. Or on these speculative assets. For example, you could suggest that the very thing everyone's hoping for, cheaper money from rate cuts, is the fuel that's overheating the AI segment.
So the solution is also the problem.
The solution is also the problem. It's the only thing that might be preventing a deeper global pullback, like what we've already seen in Asia. And once you have that central conflict, you make sure every single section refers back to it. That keeps the focus razor sharp.
That's a much stronger framework. Okay, so that moves us pretty naturally from the structure to the actual depth of the argument. The material makes a really strong case for the bubble fears. It brings in big names, specifically citing someone like Ray Dalio. The money supply ratio. Yeah, warning that U.S. equity wealth to money supply ratios look a lot like the peaks right before past crashes. And that's a very compelling historical anchor for the warning side.
It is, and including those historical markers is vital. But to really make the tech bubble fears robust, the analysis needs to more strongly incorporate factors that challenge how severe those warnings are.
So, the other side of the coin.
The other side of the coin. The weakness right now is that the piece leans so heavily on the historical metrics, like Dalio's ratio, and this idea that the AI spending drive might just fizzle out.
Right.
But it doesn't adequately explore the current fundamentals or, structural defenses that might make this market different from past crashes. By focusing only on the warnings, you end up with an unbalanced perspective.
That's fair. The bifurcation in the market feels very real. You have big tech, and then everything else. But how do you really argue against a huge macro warning like Dalio's? His metric is backward-looking by design. Can you really counter that with, say, the latest quarterly earnings from a few big tech companies?
The goal isn't to defeat the macro argument. It's about providing balance, so the reader can see the whole picture.
Okay.
So the suggestion is to introduce a dedicated section, or even just a subpoint, that explores why this time might be different, or at least what structural elements are mitigating the risk right now. That provides the counterweight the reader needs to weigh both sides fairly. So, for example, you contrast Dahlia's macro warning with some micro fundamentals. What specific earnings are holding these valuations up? Or what about the technology adoption metrics? Maybe they're stronger than in past bubbles. You could also explore if the risk of the AI spending drive not delivering huge revenue right away is maybe offset by guaranteed cost savings,
Oh, that's interesting.
right? The massive efficiency gains that AI offers businesses. I mean, those operational improvements could support valuations for a long time, even if revenue growth is a little disappointing. That's a big difference from, say, the dot-com era, where many companies had no profits at all.
I like that. Focusing on efficiency gains, not just revenue hope, gives the argument a much more solid analytical footing. Okay, so in that what to watch section, how do we make that more actionable instead of just saying earnings might disappoint?
You give the reader a clear yardstick. When you list what to watch, explicitly mention what those earnings from tech and AI companies need to prove to justify their prices.
What the inflection points are.
Exactly. Don't just say they might disappoint. Ask the questions. Are investors looking for profitability now, or are they still rewarding pure user growth? Is the focus on this quarter's numbers, or is it on future spending commitments in the pipeline? By giving them those measurable goals, the analysis becomes much sharper. You empower the reader.
That balance in depth then leads us right into the final section, which is the implications for investors. The material here is sound. I mean, it covers the basics. Focus on your time horizon, diversify, manage risk with stop losses. It's all solid, responsible advice.
It is solid advice, but it's also very generic, especially in the context of the specific market tension you just spent all this time building up.
Okay.
Things like diversification matters or set stop losses are always true. They don't provide tailored value for navigating this unique conflict between Fed hopes and AI valuations. The advice needs to bridge that gap between your great macro analysis and the reader's actual portfolio decisions.
So the weakness is that the advice feels decoupled. It's like it was written for any market condition, not this specific one.
Exactly. Decoupled is the perfect word.
How do we knit them back together then? Turn that general guidance into something really actionable using the points we've been discussing.
The suggestion is to restructure the investor advice so it directly addresses the trade-offs of this specific climate. Turn the general guidance into strategies that are tied directly to the evidence you presented. The Fed, AI exposure, the global spillover risk. Let's just take diversification. You should refine that point, instead of just suggesting, healthcare or staples.
The usual suspects.
The usual suspects. Specify where to diversify based on the global stress you mentioned earlier. You talked about the Nikkei, for instance. Use that.
So you're saying focus on markets outside the U.S., maybe look at European indexes or certain emerging markets to hedge against this U.S.-centric AI volatility? That's way more specific.
Exactly. Be specific about the geography of the hedge because your analysis highlighted global pressure points. You could suggest something like, if U.S. tech and AI feels overheated, specifically consider value stocks in markets outside the U.S., maybe in regions less exposed to the AI hype cycle, given the stress we're already seeing in benchmarks like Japan's.
That turns it from a generic tip into a real strategy.
It's a dynamic, geographically aware strategy.
And for risk management, I guess connecting stop losses directly to the technical levels you mentioned seems like a no-brainer.
Absolutely. You link risk management directly to the market themes. You suggest setting stop losses tied explicitly to those technical levels on your watch list. For example, if the S&P or NASDAQ break key support levels. That makes the advice reactive to the data in your analysis, not just some general safety rule. And finally, that time horizon focus point. For short-term investors, the advice can't just be write it out.
Right.
It should be about leveraging the source of all this uncertainty. You need to address how they can use the upcoming economic data, the CPI reports, jobs numbers, consumer sentiment, to manage the volatility that's coming from that rate uncertainty.
So you're tying their short-term strategy directly back to the Fed, back to that central conflict.
You're making the advice uniquely valuable for this exact moment in time.
This has been incredibly helpful. Okay, so to recap the three main opportunities here, First, synthesize those conflicting themes, the rate hopes and the bubble fears, into one sharp, cohesive central thesis. Make that tension the engine of the story.
Exactly. And second, you need to strengthen that analytical depth. Bring in the counter-arguments for why this market might be fundamentally different from past bubbles. That gives the reader the necessary balance to see the whole picture.
And finally, take that solid investor advice and make it hyper-specific and actionable. Link the strategies directly to the Fed, to AI exposure, and to that global spillover risk. Don't let the analysis and the advice live in two separate worlds.
Following these steps will make your analysis so much more engaging and robust. It's really strong work. We look forward to seeing the refinement. Please send the revised material back to us when you're ready for another critique.